Hello, fellow intelligent investors. My name is René Zellman, and one of the most frequently asked questions in the world of investing is when one should sell a stock. That's a good question, but my observation is that people are actually selling too frequently. So an even better question is certainly when one should not sell a stock. So if you have been guilty of selling a stock that eventually turned out to be a successful investment, maybe a multi-bagger even, I would like to provide some help in this video, as I will present 5 reasons that are not valid reasons for selling a stock. So stay tuned.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zellman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, so as I said, one of my observations is that investors are actually switching too much. In a way, they are trying to time the market by trading in and out of positions. I think if you've been able to find a truly wonderful business available at an attractive price, it's actually your job to sit still and sell rarely. I truly believe that if you are selling a stock fairly quickly, you are basically confessing that you have made a mistake. And in his book 100 to 1 in the stock market, Thomas Phelps also argued that the shorter the time an investor held a stock, the bigger the mistake of buying the stock in the first place. So let me present 5 reasons that people frequently put forward when selling a stock that I think are not valid reasons for selling. And before I present the first one, if you enjoy these kinds of videos, please make sure to hit the like button, and if you are new here, hitting the subscribe button would obviously also help me out a ton. Thanks. So the first one is easy. I think you should never sell a stock because you need money for an emergency. Major car repairs or home repairs like fixing a leaking roof are some of the most common unexpected expenses. And medical expenses are another type of emergency expense that are usually not expected. Sure, some health costs like checkups, medicines, or a temporary minor illness are normal expenses and you can budget for them in a way. But if you're hit by a car, we are talking about a whole different story. As we've learned from the recent COVID pandemic, things can happen fast and unexpectedly. And obviously the list goes on and on. Maybe there is a family emergency and you have to pay for a funeral. Maybe you lose your job. Maybe your laptop is suddenly broken. All of these expenses are irregular in nature and occur at unpredictable times. So clearly, even the best investors in the world will need some cash outside of their portfolio. They too need a rainy day fund, an emergency fund. And essentially, a rainy day fund is money that you stash away for all those unexpected financial surprises that life sometimes throws at you. When you're already going through a stressful situation, it can help you reduce the pressure if you already have some money set aside to cover these surprise expenses. If we now move on to the second reason why investors should not sell a stock, then I believe that one of the most stupid and yet most common reasons private investors in particular are selling shares is because they think, or some even know, that the market is going to crash. As soon as it seems like the market is going to drop sharply, these wannabe investors try to sell everything they have. And admittedly, we are constantly surrounded by news that imply that a significant market sell-off is pretty much around the corner. Every single day we will encounter news about geopolitical tension, QE, interest rates, or inflation risk. And again, the list could go on and on. The financial media tends to provide a lot of attention to market gurus and crash gurus in particular and their forecasts. But the data shows that most of these gurus actually fail miserably in their, I would say, subjective predictions. You can, for instance, take a look at the paper Evaluation and Ranking of Market Forecasters by David Bailey et al. And I will add a link to that essay or study to the description box below. And the authors conclude, across all forecasts, the accuracy is around 48%. Also, the distribution of forecasting accuracy is very similar to the proverbial bell curve, implying that the outcomes are due to randomness. Following the more random nature of short-term returns, this is another argument supporting our findings of random performance of forecasters and that existence of little skill in doing so. I believe no one, not even CNBC, can consistently time the market. In fact, you do not only have to correctly predict an event and how the event unfolds, so for instance how COVID-19 would spread, but also, and maybe more importantly, how people and the stock market will react to that event. So in essence, there are multiple levels of speculating involved here. Even if you would have been able to predict and model how the pandemic will evolve exactly, you wouldn't have been able to predict the sharp rebound we observed on the stock market following the March lows. Let's say you had lived on a distant island for the past 13 or 14 months, and you now receive news about the pandemic and its economic implications. What do you think? Where is the stock market compared to last year? You probably would guess that it is lower. And I would like to quote Jim O'Shaughnessy here. He said the following: "I don't know how the market will perform this year. I don't know how the market will perform next year. I don't know if stocks will be higher or lower in 5 years. Indeed, even though the probabilities favor a positive outcome, I don't know if stocks will be higher in 10 years. Overall, I think it's fair to say that far more money has been lost by investors anticipating market corrections than has been lost in corrections themselves. I think the best thing an investor can do is to completely ignore forecasts and predictions made by these market or crash gurus. Essentially, we just said that tuning out the noise is essential. And this brings us to the third reason not to sell a stock. You do not only need to tune out macroeconomic noise, but also company-specific noise. In my view, it is important to track how the fundamentals of a business you own develop. But nonetheless, I believe that you can pretty much ignore quarterly reports. Who cares if analysts' revenue estimates were missed? Instead, focus on the long-term development of the business, the long-term vision of the management team, and look past the non-essential details and try to focus on the big picture instead. So whenever a company releases disappointing quarterly results, I think you have to ask yourself if the company's long-term prospects have really changed. Normally, a small earnings miss shouldn't actually be worth writing about. Yet financial news and ultra short-term focused analysts will obviously create a lot of drama whenever a company disappoints in the short term. But if you truly think about it, for the owner of a generally successful company that has performed well over the course of the last decade, a small shortfall in a single quarter should be pretty insignificant. And we want to adopt this business owner mindset too. In fact, an earnings miss shouldn't affect the intrinsic value of the business very much. So the net present value of all future cash flows. In the context of a discounted cash flow method, so a DCF, the magnitude of a small quarterly miss seems ridiculous even. The next quarter's earnings or cash flows make up maybe 1% of the net present value of the company, which in turn means that the other 99% of the value comes from everything following that single quarter. So I think extending your investment horizon to 5 years or 10 years even, and beyond that, and developing conviction regarding the robustness of future cash flows and regarding management's talent and abilities is certainly the wiser approach than relying heavily on short-term numbers. Next, I believe that another common mistake is to sell a stock just because it has underperformed in the short term, in the recent past. At some point in the future, I will certainly also make a video about X reasons to sell a stock. And I can guarantee you that all of the legitimate reasons for selling a stock have nothing, or at least very little, to do with the share price of a company or the company. In fact, I think making investment decisions based solely on the price and how the price developed in the recent past is dangerous. You're basically adopting the mindset of a trader as opposed to the mindset of an actual investor. And there's a very big difference between these two approaches. Keep in mind that the stock market is just a barometer of investor sentiment. And sometimes Mr. Market goes nuts and doesn't make you rational offers. Thus, the price of an individual security may fall sharply without there being anything fundamentally wrong with the company. And a stock that has fallen in value, or in price I should say, may still be a perfectly sensible investment to hold on to. If anything, I think if the fundamentals of the company are intact and the price drops sharply, this might present a buying opportunity, because then you can buy a fundamentally strong business at a lower and more attractive price. But it's certainly not a reason to sell a stock. Let me quote Warren Buffett here and what he wrote in his 1997 letter to shareholders. He compared shares of a company to hamburgers. A short quiz: if you plan to eat hamburgers throughout your life and are not a cattle producer, should you wish for higher or lower prices for beef? Likewise, if you are going to buy a car from time to time but are not an auto manufacturer, should you prefer higher or lower car prices? These questions, of course, answer themselves. The answer to this question here is, of course, that lower prices are better for consumers of these products. And similarly, low prices of stocks are good for the consumers of stocks, so investors. And here's how Buffett explains this. But now for the final exam. If you expect to be a net saver during the next 5 years, should you hope for a higher or lower stock market during that period? Many investors get this one wrong. Even though they are going to be net buyers of stocks for many years to come, they are elated when stock prices rise and depressed when they fall. In effect, they rejoice because prices have risen for the hamburgers they will soon be buying. Now lastly, I think it's also a bad idea to sell stocks simply to lower your taxes. The concept of tax loss harvesting refers to the idea of selling an investment at a loss in order to reduce your tax liability, to reduce your taxable capital gains on other investments. In my view, this only makes sense if you already wanted to sell a stock for other fundamental reasons. But selling a stock to tax loss harvest is usually a losing strategy. Now, I think I could list a couple of other reasons here not to sell a stock, but I think that should be it for this video. As I said, if you enjoy my content, please be sure to hit the like button, to leave a comment, and maybe you can also subscribe to the channel. I would love to hit the 1000 subscriber mark fairly soon, and any help to get me there is obviously much appreciated. So as always, may your finances and investments prosper. Good luck.